if you promise somebody an annuity that's going to pay them 3 or 4%, and now you find that you're reinvesting your money at 1% or something, you know, you're going to disappear. If you need to get 3% and you're only getting 1%, the answer is to quit giving 3%. It's not to try and get the 1 up to 3 and do more dangerous things. You should always adapt your consumption to your income. You shouldn't try and adjust your income to your consumption. That's a basic principle for individuals, businesses, and everything else. And reaching for yield is really stupid, but it's very human. I mean, and I understand it. And people say, well, I saved all this money all my life and now I can only get 1% out. What do I do? And the answer is you learn to live on 1%, unfortunately. And you don't go and listen to some salesman come along and tell you, I've got some magic way to get you 5%. If you were to say, and let's say the stock market didn't change for 2 years and interest rates didn't change. So you had a 2-year period and you said, we'll sell off all the businesses. I don't think, I mean, you have the expenses of selling them. Now, if you sold them all to people who leveraged them up to their maximum, you might get a little more than the stock is selling for. It would be very tax inefficient, very tax inefficient. Interestingly enough, up till 1986, it wouldn't have been. I mean, there was a general utilities doctrine that governed corporate breakups. And so you could dispose of businesses or securities, if you did it right, you could dispose of securities or businesses that had appreciated without a tax at the corporate level. That was done regularly in various ways up till 1986. They revised the tax code big time. They killed general utilities. You can't do that now. Now you can have spin-offs, this business or that business. You probably have to lie a little in terms of your purpose in order to get the best tax ruling. And it takes time, but you cannot break up, you cannot dispose of the entire business, business by business, without having very substantial tax liability. It would not produce a gain. On the other hand, having them together produces, there's some very valuable synergies in there. Now, we don't use leverage as much as the people who would buy them piece by piece would do. So we could leverage Berkshire up to the sky. I've promised people we won't, because we have insurance promises to people out 50 or 100 years, and we've got shareholders who are going to own the stock for 50 years, and they do not want us to leverage to the sky. Well, I don't know I have any special thoughts beyond the news on the coronavirus. The very first day I bought stocks was March 12th, 1942. And the stocks were down about 2% that day, as it turned out. Unfortunately, I bought in the morning, so when I came home in the evening and my dad told me the execution price, it was down 2%. But, if you're buying a business, and that's what stocks are, businesses. In fact, people will be better off if they say, I bought a business today, not a stock today, because that gives you a different perspective on it. Then presumably, if you buy a farm, if you buy an apartment house, if you buy a business, you're going to own it for 10 or 20 or 30 years. And the real question is has the 10-year or 20-year outlook for American businesses changed in the last 24 hours or 48 hours? And you'll notice many of the businesses we own, partially own. American Express, we've owned it for 20 years. Coca-Cola, we've owned it for 40 years. Those are businesses. And you don't buy or sell your business based on today's headlines. And if it gives you a chance to buy something that you like and you can buy it even cheaper, then you're good luck, basically. If I knew what the market was going to do, obviously, but you don't. I don't think anybody knows what the market's going to do. I think you do know whether you're making an intelligent purchase at a given price. Everybody, when they buy a stock, if you're going to buy, say, General Motors, that has 1,400,000,000 shares out, you should be able to take a yellow pad like you have there, and on one page say, let's say it's selling for 30. It isn't selling that low, but that'd be 42 billion. You should say, I am buying the General Motors company for $42 billion because, and you should get it on a piece of paper. And then if you want to have a separate piece of paper, it says, I think I know what the stock market's going to do, so I know whether it'll be higher or lower. But you don't. In 1932, General Motors had 19,000 dealers. That's more than all the auto dealers in the United States today. There were only 125 million people then, but they had 19,000 dealers. they produced or sold, and there was one month, I think, when they sold less than a tenth of a car, right at a tenth of a car per dealer. That was a terrific time to buy General Motors. and forget about the market. If you can predict the market, you don't need to read balance sheets. You don't need to read anything. You certainly can't predict the market by reading the daily newspaper. That is for sure. And you really can't. You certainly can't predict the market by listening to me. But you're buying businesses. And if you had planned to buy a local service station yesterday and it was closing day, I don't think you'd tear your hair out or anything like that. You'd have already looked at where it was located and the contract that it had with the suppliers and made a decision on competition. People, because they can make decisions every second in stocks, whereas they can't with farms, they think an investment in stocks is different than an investment in a business or an investment in a farm or an investment in an apartment house. But it isn't. If you get your money's worth in terms of future earning power over the next 10 or 20 or 30 years, you're going to have made a good investment. And you can't pick them from day to day. If you can do that, you can, well, I haven't met anybody yet that knows how to do it. Well, if you look at the present situation, we've talked about this before, that you get more for your money in stocks than bonds. That doesn't have to be the case. I mean, but it's usually been the case in America, very usually been the case. And if you buy a 30-year bond today with a yield 2%, you're paying 50 times earnings for an investment where the earnings can't go up for 30 years. Now, if somebody said, I want to sell you a stock that's at 50 times earnings and the earnings can't go up for 30 years, you'd say that doesn't sound very good. Stocks are way better than 30-year bonds. I mean, that's clear. And that's one of the alternatives people have. People really have three basic alternatives. Short-term cash, which is an option of doing something later on. Long-term bonds or long-term stocks. And stocks are cheaper than bonds. There was trouble coming in 1942 when I bought that first stock, all kinds of trouble. Philippines were going to fall pretty soon. There was all kinds of trouble in 1949. There was trouble, certainly trouble in 2008 when I wrote an article for the New York Times. I said trouble is coming, but I said buy stocks. I've been a net buyer of stocks, or I've actually been a personal net buyer of stocks ever since I was 11, every year. You know, we buy a few stocks, but we don't look at, we're not buying the stock market. We're saying, I am buying, let's say American Express. We own American Express. There's 815 million shares out and sells it. This morning's 126 or something like that. So it's selling for roughly $100 billion. Now, the real question is whether the company's worth more or less than $100 billion. It isn't what the stock is going to do tomorrow or next week or next month.